The business end of the deal, couple of quick business questions. Dave, what up, Dave? If you move from a sole trader to a trust, do you need a business valuation, and will it trigger tax issues? Look, you could probably ask that question if we move from a sole trader to a company trust or a unit trust. We're restructuring the business. I'm going to shut up now because I know enough to be dangerous, but surely there'd be some type of exemptions.
Yes, so there is a small business trust restructure rollover, which allows you to go from a sole trader to a trust without triggering capital gains tax.
Can that be a unit trust or a discretionary family trust?
Yes.
Okay.
You then...
That was a confident yes, was it?
Yes.
Check with your accountant, everyone.
Check with your accountant. Look, these type of things...
Sorry, it's the end of the episode. No one listens here.
Goodo.
Yeah.
It's a very complicated area.
Yeah.
So if you are in this space, then you need to be seeking advice because it's very specific. But generally, if you are moving from a sole trader to a trust, then you don't trigger the capital gains tax, which means that you roll over the cost base from those assets you had and put them into the trust, which defers the capital gain. So there's a few conditions though. There has to be no ultimate change in the underlying ownership. So the same family,
beneficial owner.
Yeah, the same family is still the sole trader is now the trust. The restructure is genuine and it's for commercial reasons. So there's you need to make sure everything you do has commercial reasons, and these assets in the business are actually active assets. But to answer Dave's question, yes, you will need a valuation because you need to help determine the market value of that stock. It's not the cost that you actually paid for it, it's the market value. And that could be goodwill as well, which needs to be transferred to the new structure. So, yes, you need to definitely make sure you get a valuation.
But that could be
it doesn't need to be.
You don't have to pay a value of $5,000. It can be
No.
just like, okay, here's the stock at value. We own some other equipment.
Maybe it's engaging a real estate agent. If you've got some property there, maybe it's 3 or 4 agents to get an idea of the value of the property.
But that's a broader discussion because we're not moving a property into a trust and trading out of the same. Anyway, but you vibe me.
You know what I mean.
Yep.
It's about, how do you come up with what's a reasonable market value?
Yeah, just so if you get a please explain in 5 years' time.
Exactly. You need to have the paperwork and you need to have it very well documented as to, well, how did we come up with this? And when you have those commercial reasons as to why you've done something, the paperwork needs to support it because effectively the onus is on you as the taxpayer to prove that this is why we did it. This is the reasons and this is the value.
Daniel, does business income affect your or your spouse's personal income tax? Well, that's $1 million question, isn't it?
Yes, it does. So business income, if you're doing this under your tax file number, that gets added to your other income. So
when you say doing this under your tax file number, is that AKA a sole trader?
Sole trader. Yep. So if you're a sole trader, then yes, say you've got a small plumbing business, but then you also work as a plumber for an employer. So you get a payment summary, you get weekly wages, but you also have this business on the side. All of that net income from the business gets added to all your other income. So that then is what's taxed. Now, you may find that you end up with a tax bill at the end of the year if you haven't been paying PAYG instalments throughout the year. So that is just an instalment of tax that the tax office want every quarter because they're not getting tax from the employer every week or every fortnight like what you do from your wages and salary income. So yes, it does impact your tax. You need to be mindful that you may have a tax bill at the end, particularly if this is the first year. If it's an ongoing thing and you've had it in the past, then I suspect you would be paying instalments throughout the year, which means then the tax is pretty much covered. And yes, it will impact, it doesn't specifically impact your spouse's income, but combined income determines like your private health insurance rebate, Centrelink benefits, family tax benefits, childcare subsidies, the Medicare levy surcharge. So yes, this, while it doesn't directly impact your spouse's taxable income. It does through these other things.
Yeah, and that's it. It's and that could be one of the reasons, Dave is moving from a sole trader to a trust. Dave's partner, if he's got one, might work in the business as well, and
It allows for some income splitting.
Yeah, we've got some
to
some razzle dazzle happening.
Spread some income that way.
Finally, work from home. Over the last 5 years, there were some changes, with COVID and a statutory cents per hour of working from home, blah, blah, blah. If you are working from home, how do tax deductions work, and what work from home expenses can you claim? Electricity, internet, depreciation. Someone else wrote in the group after I'd kind of sent you these questions about if I working from home in one of the bedrooms, can I claim that room on tax? Blah, blah, blah.
Yes.
I'm going to leave that with you, and I'm going to go and get a coffee.
Oh, well, let's open a can of worms, right? So there are two methods that you can claim working from home. The first one is that fixed rate method, which you said. That's currently 70 cents per hour, and that covers all of the expenses. So that bundles everything together. That's the gas, the electricity, the internet, the home phone, the mobile phone, the stationery, the computer, consumables. And you end up with how many hours you've worked. Apply this rate to it. That's the deduction. So you don't need to keep all of these bills. You don't need to keep those records, because the only thing you need to keep is the hours that you've worked. So diary entries, timesheets, rosters, calendars, whatever that looks like, because again, if the tax office ever come and ask, it's on you. You have the onus to be able to prove how many hours you've done. So you just need to know how many hours you've worked. You can claim depreciation on your laptop and your monitor. You can claim the repairs on those things separately. But for all of those expenses that I mentioned before, you don't then claim that separately. So that's the first method. The second method is the actual method, which tends to get a lot more complicated because...
is it right to say the actual method, you might end up getting more back, but you have to work harder for it by keeping records and all that?
Yeah, absolutely.
You got to work for your dinner, kids.
Yes, it's not just a free ride, right? So... yes, you claim a proportion of all of those expenses based on the usage. So you need to keep receipts for everything. You need to keep a lot more detailed records.
It's good, England.
I know, sorry.
Hey, we are recording this, everyone, on a Friday freaking afternoon because it was the last minute.
It's been a long week, right?
Yeah, it has. It's been a long life.
Yeah. And now we're talking working from home deductions.
I know.
Yeah. So actual method, you need to have your records. You need to keep very detailed reports on, again, your hours that you've worked, but you need a logbook. So you need those receipts. You need to keep all your gas and electricity. You need to keep all your internet, all your phone bills. You make sure, though, you don't include things like tea and coffee or rent or mortgage unless you're self-employed and you've got that dedicated home office. So that's different. You can't claim your work clothes. So really we're just talking about the office space of actually using this space within your house to claim it. Another thing you need to be careful of is travel deductions when you've got this working from home. Travel is normally not deductible between home and work. If you're working from home, that determination can get a little more tricky because you need to work out, well, where is the actual base for your employment? And so are you working from home just a couple of days from a week, but the office in town is the actual office? You're just choosing to work here for a couple of days. So therefore, if you go in for a meeting, that's not deductible because the office...
that's your office.
That's the workplace.
Yeah.
So if you don't have an office, if you don't have anywhere else, then, looking at your personal circumstances, is this your place of business? Then possibly you can claim some travel. But that's a conversation to work out exactly.
This is highly, in this hybrid workplace environment that we are living in, this is such highly personal, circumstantial. Like, here's the thing. If you're self-employed and you work from home and you rent, you could claim a square meterage of your weekly rent. But you wouldn't potentially do that if you own the property because it's going to dick with your cost base for
Capital
gains tax exemption.
So you don't want to jeopardise your principal place of residence.
Yeah.
So it is really quite complicated. That's why a lot of people just go with the cents per hour method.
Now, any other kind of comments on that cents per hour versus like statutory, I think you would call it, cents per hour method versus the crunch it, spreadsheet it? I mean, at least do something if you are working from home.
Yep. How much detail or how are you with attention to detail?
Not great. No, I am for things that matter.
But that's the question, right?
The
like
question
you
to
can't
everyone.
half-ass it. You've got to do it right.
Yeah.
So are you prepared to put in the work? Yes, it may be a bit more work, but it could end up being quite a significant deduction.
Did I hear, and I haven't crunched this, but if you did the nominal 70 cents an hour, it's like an 8 hours from home or something. It ends up being like $80 a year or something like that. It'd be really easy to crunch, but
Yeah,
it's
look,
not.
it's
This
not
is not
huge.
game-changing money.
No,
but
it's
it's
not
available
massive.
to do.
Yeah, absolutely. And if you are working from home a lot, then, you know, it's money for jam, right? You're entitled to it, but you need to keep the records. Like everything, if the tax office ever ask about any of your deductions, you have to substantiate it. So how are you going to do that? What are the records that you have? So, yeah, it doesn't end up being a huge amount, but anything is better than nothing. We obviously don't want to give the tax office more than what we should and claim what we're entitled to. But just make sure you've got your records. Like that comes down to all of this stuff, all your deductions. Make sure you've got your records. You can't just put in this nominal $300 and claim that.
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.